I spent years at a normal salary, 42 grand, give or take, thinking I was the problem. Thinking if I just got a little more disciplined, tracked my spending a little more carefully, drank a little less coffee, I'd finally stop feeling like I was running in place. Then I found the receipts, and I want to show them to you. Not my opinion, not a theory. 4 charges, all of them documented, all of them sourced from filings the people running this system had to publish by law. Federal Reserve data, FDIC quarterly reports, Bureau of Labor Statistics. These aren't advocacy documents, they're their own paperwork. Here's the first number, I'm putting it up front because it sets everything else. Productivity in this country went up 80.9% between 1,979 and 2024. Wages inflation adjusted median worker went up 29% over the same 45 years. Productivity grew nearly 3 times faster than pay. That's not a statistic. That's a gap, and we're going to talk about where the gap went. Charge 1. Let's go back to 1,979 for a second, not because I love history, but because something specific happened that year that nobody in personal finance ever talks about. From 1948 to 1979, 30 years, productivity and wages moved together in lockstep. You produced more, you made more. That was the deal. There's actually a graph. The 2 lines hold hands for 3 decades, and then one of them just leaves. After 1979, productivity kept climbing. Wages slowed down. And here's what I want you to sit with. The Economic Policy Institute, which pulled this from Bureau of Labor Statistics data, specifically writes that the divergence can't be explained by slow productivity growth or inevitable economic forces. Those are their words, not mine. It was policy, the erosion of collective bargaining, globalization, macroeconomic decisions that tolerated excess unemployment and suppressed labor's ability to push back. Decisions got made, and the decisions had beneficiaries. Now let's translate that into something you can actually feel. The average production worker in this country earns roughly $30 an hour right now. If wages had grown at the same pace as productivity since 1979, not faster, that number would be somewhere around 42, 43 an hour. The gap is roughly 10 to 15 bucks an hour. Call it $12 every hour, every shift, annual. That's somewhere in the range of 20 to 25 grand a year that productivity growth could have delivered to the average worker and didn't. Now hold that number for a second, because it doesn't just affect this year's paycheck. Here's what compounding does to it. If a worker started receiving that missing 12 an hour today and invested it conservatively, 8% annualized over 10 years, that's roughly 360 grand in additional wealth built. Not from winning, not from picking stocks, from receiving what the labor math said was already there. Corporate profits as a share of GDP were under 6% in 2000. By 2024, they were at 11. 5 percentage points on a 29 trillion economy works out to roughly 1.45 trillion redirected annually from wages to the people who own the capital. The productivity gains didn't disappear. They showed up in earnings calls, they showed up in buybacks, they showed up in executive compensation packages. Now, and I want to be clear about this, that doesn't mean you're stuck. Knowing where the extraction happens is the first move. You can't play a game differently until you know the rules. Charge 2. And while your employer was capturing the productivity surplus, your bank was quietly running a completely separate operation. Here's how a savings account works, the part that doesn't make it into the commercial. You deposit money. The bank takes that money and lends it to other people at a markup. The difference between what they pay you and what they charge everyone else is the revenue model. That's been true for 100 years. Fine. But let's look at what the spread actually is right now in 2026. Chase Bank, biggest bank in the country, pays you 0.01% APY on a standard savings account. That's the number, not 0.1. 0.01. On 10 grand sitting there, you earn $1 per year. 1. Actual dollar. 1. Now, the average personal loan rate is around 12% APR. That's what Chase and banks like it charge when they lend money out. So Chase takes your 10 grand, lends it to someone else, earns $1,200 on it, and hands you $1 back. The spread, what they earn on your money minus what they give you, is the product. Not the checking features, not the app, not the fraud alerts. The spread is the business. And in the fourth quarter of 2025, the FDIC reported that the U.S. banking industry's net interest spread hit 3.39%, the highest it's been since early 2019. That spread widened because deposit rates fell faster than lending rates fell. They cut what they paid you before they cut what they charged you. That's not a coincidence. That's a sequencing decision. Total U.S. banking industry net income in 2025, $295.6 billion in 12 months. Now, quick visual, because I think this one deserves it. Imagine someone deposits 10 grand at Chase, and the teller slides back a single dollar bill in a small envelope labeled "Your Annual Earnings." The teller is completely fine with this. Nobody in the building finds this unusual. This is the transaction. The account you want is called a high-yield savings account, an HYSA. Right now, the best ones are paying 3.5 to 4.5% APY. Same FDIC insurance as your Chase account. Same federal guarantee. Zero difference in risk. 10 grand at 4% earns you $400 a year instead of $1. Over 10 years, the HYSA version of that account becomes roughly $14,800. The Chase version becomes $10,010. Nearly 5 grand gone. Not lost in the market. Not spent on anything. Transferred to them. Because the account lived in the wrong building. The HYSA exists. They just don't advertise it to you. They advertise peace of mind, security, the app. The spread is not in the brochure. And here's the behavioral piece that makes this machine hum so smoothly. Your savings account was probably set up years ago when you opened your first checking account, or as part of a bundle, or because direct deposit got linked to it and switching felt like a project. Banks actually count on this in their earnings calls. Deposit stickiness is a real term. It means we know you won't move. The minor inconvenience of switching is worth hundreds of dollars a year to them and costs you the exact same amount. The inertia is the product. You can open a high-yield savings account tonight. Most of them have no minimum deposit, takes 10 minutes. And I'll tell you exactly where to start at the end of this video. First, charge 3. And this one is the one I want you to actually look up while you're watching this, because the paperwork already exists and you've probably never read it. Pull up a credit card statement, anyone with a balance on it. Scroll to the bottom, sometimes the back, and find a small table labeled something like minimum payment warning. Federal law requires them to put it there. Most people have never read it. Here's what it says in plain English. If you have a $5,000 balance at 22.3% APR, which is the current national average for accounts actually carrying interest, straight from the Federal Reserve G19, and you pay only the minimum every single month, you will spend more than 20 years getting out of it. And you will hand the credit card company more than 7 grand in interest on a $5,000 charge. You pay back $12,000 on a $5,000 bill. Here's how that math actually works, because the formula is the story. Month 1, balance $5,000. Monthly interest at 22.3%, APR, $92.92. Minimum payment, typically 2% of the balance, comes out to $100. So you pay $100. $92 of it goes straight to interest. $7.08 comes off the principal. New balance, $4,992. Month 2. Your minimum drops slightly because it's 2% of a slightly smaller balance, meaning you pay a little less, meaning the interest takes an even bigger slice of that smaller payment. The formula is self-correcting. It adjusts downward as the balance falls. So for years, the vast majority of every payment you make goes to interest, not principal. They called this the minimum payment, as if that's a courtesy, as if that's the bank looking out for you. The minimum payment is not a consumer protection feature. It's an engineering decision. It maximizes the number of months you're paying interest, which maximizes the revenue they collect. They show you the smallest number they can get away with showing you because the longer you stay in, the more they make. The math on that is not subtle. It's in the cardholder agreement. Nobody reads it. Scale this up. Total U.S. credit card debt at the end of 2025, $1.277 trillion. That's a record the highest the New York Fed has tracked since it started tracking in 1999. The average APR on accounts carrying a balance, 22.3%. In 2024 alone, consumers were assessed over $160 billion in credit card interest. That's not the balance. That's just the fee for staying in it. And here's the move, because I'm not going to leave you there. If you have that $5,000 balance and you switch from minimum payments to $250 a month fixed, same every month, you're out in about 2 years. Total interest, roughly $1,100 instead of $7,000. Difference, $5,900 saved, 18 years freed. The formula runs on inertia. It stops working when you change the input. That's all it takes. One more charge. And this one is different because it's not about a number. It's about what you were told the numbers meant. For the past 20, 30 years, there's been a profitable industry built on a single foundational assumption that you are the variable. Dave Ramsey, YNAB, Mint, the total money makeover. Every latte factor article ever published. All of it constructed on the premise that your spending behavior is what needs fixing. Your discipline, your habits, your choices. If you would just track more, sacrifice more, want less, you'd be fine. Nobody selling you a budgeting app is going to walk you through a 51.9 percentage point productivity to wage gap. That's not a product that sells. Nobody writing a bestseller about the debt snowball is going to explain how your bank earns $1,200 on your deposit while handing you $1 back. Nobody making money on the self-help industrial complex is going to tell you that the diagnosis they're selling you have a discipline problem is wrong. Because a wrong diagnosis is a repeat customer. And here's the part that actually bothers me, because I live this. When you've been handed the wrong diagnosis and you follow the treatment and it doesn't work, what do you conclude? You don't conclude the diagnosis was wrong. You conclude you weren't disciplined enough. You try harder. You buy the next book. You download the next app. You track more categories. You cut more things. And when that doesn't fix it either, you stop trying because you've decided the problem is you, not the wage gap, not the savings spread, not the minimum payment formula. You. I remember sitting at $42,000 a year, doing the math on my budget for probably the 6th time, trying to figure out what I was missing. I wasn't missing anything in the budget. I was missing the part of the picture where the system had already taken its share before I ever saw the money and was quietly taking another share of what was left. Nobody hands you that picture. You have to go find it, which is what we just did. Someone made a very comfortable living telling you the problem was your coffee. They were not lying by accident. Telling you the problem is structural. The wage gap, the savings spread, the minimum payment formula produces a viewer who changes one account and one payment habit. Telling you the problem is behavioral produces a subscriber who buys the extended course. You weren't bad with money. You were navigating 3 active extraction systems simultaneously, all running in the background, all documented in their own filings, none of them ever mentioned in the personal finance content designed to monetize your confusion. The difference between I know the system is unfair, vague, general, and I know the system pulls between 20 and 25 grand a year from someone at my income is the difference between frustration and a target. Let's put the target on the board. Viewer at median income, call it 55 grand a year. Conservative numbers across the board, the wage gap, roughly 20 to 25 grand a year in earnings, the labor math says should have been there, captured instead by the people at the top of the productivity chain. The savings drain, 10 grand in a standard bank account instead of an HYSA, costs you somewhere between $350 and $450 a year. No risk difference, no complexity difference, just the wrong account. The minimum payment drain, $5,000 balance on a card, making minimums roughly $1,100 a year in interest that barely moves the needle on principal. Stack those 3. Somewhere between 20 and 25 grand a year that the math says should be yours every year. Not inflation, not bad luck, not a character flaw, engineering, and every single figure in that estimate came from a government database or a regulatory filing. Here's what makes that number hit differently than a vague sense of unfairness. Vague unfairness produces frustration. Specific numbers produce a target. You can't move on a feeling. You can move on a number. And the number is somewhere between 20 and 25 grand a year across 3 mechanisms, all of them running simultaneously, none of them requiring you to do anything for them to keep extracting. They run on autopilot. Your employer's compensation structure doesn't need you to do anything. Your bank account doesn't need you to do anything. Your credit card minimum payment doesn't need you to do anything. That's the design. Passive extraction is the most efficient extraction. The system documented itself. We just read the documents. Here's what changes today. Tonight, not someday, tonight open your banking app and find your savings account APY. It's usually listed under account details. If that number is under 1%, you are sitting in the default trap. Pull up best HYSA rates and you'll find accounts paying 3.5 to 4.5%, no minimum deposit, full FDIC insurance. 10 minutes to open one. That's 10 minutes to stop the bleed. The next thing, pull up any credit card statement where you're carrying a balance. Find the minimum payment warning. It's federal law. It's there. Most people have never looked at it. Read the payoff timeline. Read the total interest number. Let that number do the work. You don't need me to explain it further. It's already in their paperwork. And the last one is a seed for where we're going. On your next paycheck, find the gross pay line, not net, gross, before taxes, before deductions. That number is what your labor is worth before the system takes its cut. Most people build their entire financial picture around the net number and never ask about the gap. We're going to get into that gap. These aren't a financial plan. This is a frame change. You just watched 4 charges laid out from 4 separate sources, and the number at the end was somewhere in that 20 to 25 grand range every year. On a median income, the math was always there. Nobody showed you where to look. Now you know where to look.